let's look at a little bit of what I want to go through tonight. Is when we go to the models on the website, and you can see that we have the rotation model, only ETFs, S&P 500, the 1 401k, and annuity models, and the annuity model is undergoing a huge renovation. So until I'm done with that, I don't know that I'd tell you to log on there. But what I'm looking at right now is what is transpiring in the markets and how to kind of pare that down to you in a way that you can use it in a format that is helpful. So I have 7 roadblocks that I wanted to share tonight as we started that I think keep people from being successful at managing their money. And one, to me, number one is probably the all-encompassing, that if you can't get past number one, which is decide what you want, and that's where it really starts for me, is that you have to decide what you want in order to get where you're going. So you can do all the trading you want. You can learn all the technicals and fundamentals. You can learn everything you want to learn. But if you don't really understand why you're doing this and why you want to do this and what you want to get from this, I think you're just going to self-destruct psychologically as the market goes through cycles. The only thing that keeps me going day to day is knowing what I want from managing portfolios. And, it was like meeting with one of my clients yesterday. People who've even been clients of mine for 15, 20 years, I still ask the same question, what do you want, and has it changed from where we stand right now? So I think that one of the key components of this is understand why you're doing it before you start doing it. The second one is we tend to ignore the psychology of money, and I'm going to talk a little bit about that tonight on how we do the scans, because we use sentiment is what a lot of people talk about when it comes to the market swings and rotations. But to me, that's psychology. That's understanding the psychology of money as it relates to the investor, to the markets, to the segments of the market, and how all of that goes together, including economics and how they kind of rotate with each other. But we tend to ignore those events and look only at technical data, and I think that's a mistake. We don't apply what I call sound money management or risk management tools, which we'll talk about at the end tonight. And we ignore the natural laws of money, and that is what goes up will come down, and what goes down will go up. And we tend to forget that money has natural laws. That's why sector rotation works so well, is that there's natural laws to money. We don't continue to educate ourselves about money, and not just from a standpoint of trading, but all the way around. We try to manage the markets versus managing our money. You can't manage the markets. The market could care less about you, doesn't care what you think, doesn't care what you know. It's going to act based on the populace, and the populace votes by buying or selling shares, and it rotates to who's in control, whether it's the buyers or the sellers. Today's market, the sellers had control of the market, and the buyers did not. It doesn't mean that there were more buyers and sellers, because there has to be one of each in order for a trade to be transacted. It means that the emphasis of the sellers control the bid and the ask prices for stocks, and when the sellers are in control, the bids drop, and when the buyers are in control, the ask rises, and that's generally that's one of the most important tools I think you have to learn about the market. Is you can't manage it, you have to respect it and manage your money. And then lastly is we fail to have a written plan, which I'm going to show you some of the stuff that we go through on a day-to-day basis. Now, all of that said, I'm going to go through 3 things: scan, watch, and play. We've done webinars, and we've done seminars, and I've done multi-day seminars on this topic. So there's a lot to scan, watch, and play. But we start with the scan the market, which is what do you want from the market, and go scan to find it. If I want short-term trades, I need to build scans based on short-term trades. If I want to trade intraday, I need to build my scans based on intraday trading. But don't scan different time frames and then try to trade a completely different time frame. Look and focus on what you want from the market right now. What are you trying to capture from it? and where is it going to take you. As I was writing the updates tonight, one of the things that is very important to me right now is the last 2 trading days. I've written about this. I started writing about it last night. And what I like about the egg model and the update to the egg model is it gives you an opportunity to see the insight to how transitions in markets begin. Yesterday we talked about we had the first negative market die on volume that mattered. And today we got a follow through that mattered even more. And whether or not this follows through tomorrow on Friday, which by the way is Friday the 13th, which hopefully the superstition of that doesn't play into the markets. But the question is, will the market follow through and will it roll over? So if I go to the market today and I say, what do I want to scan for? I'm looking for topping formations. I'm looking for things that are going to roll over, and I'm looking for indicators that are going to tell me that. And that's how I would develop my scans today if I'm looking for short trades. If I'm looking for a pullback trade where you're going to get a 2, 3, or 4% pullback in the markets, and then the bounce or the reflex back to the upside, then I have to scan and look for it in that format as well. So let's look at just a couple things to start, and how you would look at today and the last couple of days is the S&P 500, which is on the screen here. You can see that we had 2 phases to the current movement in the market. The first phase of this is the April 11th low, which is this bar right here. The second phase of this is the May 15th low, which is right here. So there's 2 phases to the current uptrend that's in play in the S&P. Now, this started on April the 11th. Today is June the 12th, so this is a 2-month period in the market. And for us, this is a micro trend. This is not even a short-term trend. This is a micro trend within the market. So when you talk about trends, understand the time frame that people are referencing, because the short-term, intermediate, and long-term trends of the market are still very positive and still to the upside. We're looking at a micro trend of only 2 months in the market, and we're saying, is that trend breaking? We're not looking at whether or not the longer-term trend is breaking. We're looking at the micro trend, and that's a key element. And you can see we use a little bit longer-term regression line here. That's a 30-day regression line, and this is a 5-day regression line. And the only reason I'm using this is it helps visually see the trends while we're teaching on the webinar, so you can actually see them if I forget to draw them. But what you're looking for right now is you got a little bit of a test here. Now, are we going to get a second test? And is that test going to come back into the 1925 range, 1915 range? Where does that test of the market? Maybe today was it. We moved back to 1925, which was a key support level for the S&P. If that's the end of this test and we start the next leg up, then you have to determine, I'm looking for 2 things right now. One is I'm looking for the market to roll over on a micro trend basis. So we're looking short term, or roll down, test, and run. So those are the 2 things that we would be looking for going forward from today's trading day. And, I don't think I could have asked for the markets to set this up better to try to teach you how to look at what's going on in the market to create scanning opportunities, because that's realistically what you're looking for. And so let's take this to the next, let's go back 1 phase here. And I want to scroll this in because I want you to see what I'm talking about relative to short term. To us is 3 to 9 months. So we'd have to get this trend line 3 months out to 9 months out before we would call it a short-term trend line. The short-term trend line is right here. It's very much intact on the upside. If we take the intermediate-term trend line, which is 9 to 18 months, and we go back, that trend line is still intact. Long-term is 18 months or longer, and so you can see that even the long-term trend line is intact. On the upside, as a matter of fact, we've accelerated away from all 3 of those trend lines on a micro trend basis, and now we're testing that micro trend. So put it in perspective before you blow yourself out of proportion relative to a portfolio and how you manage it. So take what the market's doing now and deal with it, and look at what the impact it is on the different time intervals, and then go scan those time intervals when you look at what you're to want to trade, whether it's a trade, a short-term investment, intermediate, or long-term investment. So you have to manage the timelines as well as anything else. And I don't hear enough talk about timeline management when people talk about various trading styles or strategies. So when it comes down to this, what we're looking at right now, as you can see, we came back and we tested this 1925 level intraday today. We hit right near it and bounced off of it, closed at 1930. So the S&P is there. So where's the second place we're going to go? You notice all I'm doing is looking at charts right now. I'm not looking at any indicators. I'm not looking at any type of decision relative to how I want to run the scans. I want to visually understand what the market's doing before I try to go out and determine how I'm going to act on the market now. So this is the S&P. This is a scatter graph. This was a webinar we did a couple weeks ago when we talked about how to visually look at what's happening within the market. This goes back to the April 11th pivot point. You can see the May 15th pivot point. Let me get rid of this one. I don't know why it's there. But we had the April 11th, and then we had the May 15th. Those are your two pivots on this current micro trend. And then you can see very well in the bold white line is the rolling top. What we want to know now is what's leading that downside. So if we wanted to, I could come in here and put this bar in here, and I would get a picture as to what is accelerating on the downside. And one of those is, you can see IYZ, which is the light purple line, which is telecom, the yellow line, which is consumer staples. And, when I first saw that yesterday, that consumer staples actually for the last 4 days has been rolling over. But what's interesting is that it's a dividend issue. If people think that interest rates are rising, and if you look up until today before the yields fell, dividends were rising, and there was a lot of talk about that the yields were going to bump above 3.5 on the 30-year Treasury. And if that's true, then that impacts dividend-type stocks, utilities, impact. And then you get consumer staples, which are dividend-driven, get impacted by that, and that's why you're seeing those be impacted probably more so than what's transpiring in the overall market on a negative bent. Financials reacted, the consumer discretionary reacted, and you can see energy is the only one, which is the white line at the top, in a positive bias. So everything's acting pretty much in unison. It's acting in accordance with what's the story in the marketplace. So everything is kind of correlating along. And now the question becomes, how do we take that and use it relative to what we're looking for? And we could look at all the different, we can go back, and I just want to look at the 7 asset classes just so you can get a picture relative to what's going on here. I want to get this on the right pivot point here. And what you see is a little bit different picture here. You can see the blue line is DBC, which is commodities. Commodities have been moving up. Interest rates rising, commodities in a favorable environment. Generally, they're going to go hand in hand. You want to see what's driving the commodities. One was oil. Oil started out on a speculation move relative to supply. The second part came yesterday, which is Iraq. That got confirmed today. So the move in oil really is purely speculative, but is added to the energy upside on the stock side. But you got to be careful. The minute the speculation comes out of that, that trade goes away, and it would actually become more of a short trade than anything. But you got to be very careful. The commodity trade right now. Gold moved yesterday and today on that. Silver moved for the same reason. Gold miners, silver miners all moved on that. But if you look at XME, which is the mining, metals and mining ETF, that ETF actually fell today in light of gold and silver going higher because DBB, which is the base metals, actually had a negative trading day today because steel, copper, and some of the other base metals actually reversed. So make sure you understand what's going on in the market before you go out and scan the market, because you're going to get yourself in trouble. You're going to buy things that don't correlate to what's going on. And when I talked about the 7 roadblocks, one of the things I said is understand the natural laws of money. Those are natural laws of money. When the money rotation is in play, you have to understand what's going to rotate and why it's rotating. If it's diverging, then that's a whole different story. And remember, divergence is doing something it shouldn't normally do, and meaning that it's having a spaz attack, and it shouldn't be doing that, and that's what we want to know. So commodities are moving up. Treasuries are moving up, which you should. When you get any type of correction in stocks, generally you're going to see a bump in bonds. You did see that today. EEM, emerging markets, are moving down. Bump in treasuries is never good for emerging markets, so they're trading in unison. If you look at PCY and EMB, PCY is the sovereign emerging market debts. EMB is the emerging market bonds. Both of those traded lower the last couple of days, but they're trading in unison of worry about debt concerns globally and interest rates rising in the United States. So all of those are playing into the events. So you've got different movements. You can see the REITs are moving down. That's an interest rate move. Has very little to do with what's going on in the equity market. So understand what's moving the sectors as you go into them. Look at them because they're a storyline. If interest rates are going higher, then the storylines behind all of the dividend-producing assets is a valid storyline to track. And if we go back over here and we look at TYX, which is the 30-year Treasury, and you can see that there's a downline trend in play here that's trying to break higher. 3.5 is the level we've chosen, that if we break above that and hold above that, then I think rates do go higher, and I think shorts on dividend assets is a higher probability trade than they would be right now. And so that's kind of a benchmark of what we're looking for relative to those. So when I talk about scanning the market, I'm not just talking about running these scans that we'll get into in a second, but I'm talking about understanding what's happening in the market, around the market, and influencing the market's direction. And is that a short-term event, or is it a longer-term event? In other words, is it a news event that's only temporary, like Iraq? If the Iraq situation gets resolved tomorrow, that the premium in oil comes out of it right away. If you go back to the last premium pushed into oil, that was Russia and the Ukraine issue, which really, by the way, is not totally resolved, especially with oil export, which has been putting some pressure on oil supply. Throw Iraq on top of that, and then you get you get the exacerbation process of what happened today, and you get a pop in oil. So you want to find ways that you can use these. I don't put every trade up on the website, but I do mention a lot of these things in the notes. If you read through the notes, UCO, which is the 2x leveraged long oil trade, was put out there. The entry on the long oil trade happened on Wednesday. So today, that oil trade was actually up about 1.8% on the day. So it was a positive trade. But you have to look at what you're trying to trade and why you're trying to trade it. Sometimes scans don't need you to run, the MACD jumping over stochastics and the cow jumping over the moon when it's full in order to give you a trade. Sometimes the best trade setups are just purely looking and scanning what's going on in the market in and around it to set the trades up, because the conviction of those trades are much better more times than not. So Treasury yields, my point here is you can see that we're still bottoming. We've got a double bottom in play. We need to break above this 3.5% yield on the 30-year, and then TNX, which is the 10-year yield. You've got a very similar picture in that you need to get above this yield differential right here around the 265 level, and that was very close yesterday, and that has reversed. Now, the 10-year acts differently than the 30-year. Everybody knows that, but a lot of people don't look at the 30-year. The 30-year has a greater influence on dividend yields than the 10-year. The longer the yield period, the higher the yields, and the higher the yield dividend influence is going to be. So when you're tracking like an IYR that pays, which is the REITs, which pays a 4% dividend, I'm going to correlate it much more to the 30-year Treasury than the 10-year Treasury as to how it reacts. And if you look at it, it reacts very closely to the 30-year Treasury, and I don't have time to go and show you how you can do that, but you can set up charts that'll show you the correlations of groups and other things, which are a whole nother webinar that we could do of looking at just correlation. But there's a lot of things that are impacting the market right now that are setting up things that are trades that, to me, are very legitimate trades just by themselves. So let's go back and look at a different chart here so that I can go back where we were. But look at this from the standpoint that just from the things that we've talked about so far, you would find those in, I'm going to pull this back just so you can see. These are tonight's notes, by the way, and you get them in the email, the link to them anyway, in the email every night if you signed up for the email. If you haven't, then you should. And you can see here, if you scroll down, notes to note is just something that I thought it was clever, but evidently it may or not be, but I kind of like it. But these are notes that happen in the markets, whether today or things that are evolving, that we think you should take note of. And one is the volatility index today did move up to 12.6. I thought that was important. That brings the VXX trade back into play. But, those aren't scans that I'm out here running. When people talk about running scans on stocks and filtering and doing all these things, some of the best scans are just paying attention to what's going on. So if volatility is moving, then, VXX becomes a play. Oil moved to 106.40 today. I think the upside's around 110.20 on a target. I think if you take the situation in Iraq out of the picture, I think that trade goes away, and I would sell my position. But we're long UCO off of that trade, which was in the notes a couple nights ago. Energy and utilities are two sectors that closed in the green today. Energy closed because of oil and because it's been a positive sector, but oil was the influence. Utilities closed positive today because of the rotation back to the 30-year Treasury. So the dividend play came back into play for utilities, which had been selling off. But positive. Consumer, industrials, and materials, they were down today. Those are interest-sensitive sectors. Transportation down 1.9 because the airlines got slammed 4%, higher oil prices, but take that to the consumer, you get higher oil prices, it stays in play. If oil stays at 106, 110 a barrel, that's an additional tax on the consumer because gasoline is going to go up, and you add another 4 or 5% tax to the consumer per gallon of gas. And for the average consumer who fills up their tank twice a week, that means that we're adding another $20 out of the consumer. That impacts what's going on. You can see the airlines, interest rates, but it kind of flips through some of the things that we see. And then there's some charts in here. I added the scatter graph tonight so you can see what was going on. GDX, this is the third day this chart has been in the notes. We started out with GDX, but when it started to break above the trend line, and you can see it's accelerated. And then crude oil, we showed the breakout there of that upward trending channel that cleared today. And it'll be interesting to see how oil plays out. But you get a lot in the notes of things that I'm talking about. Those notes get populated every night, and they're there because I want you to see what we're seeing in the markets, and it kind of consolidates it where you don't have to spend as much time, and you can see some opportunities as they pop up. So that's the first part of the scan, is just look for the opportunities within the trends and look within the current market environment that we're trading in. So you got an environment and trends, the two go together, and look at whether or not anything is changing or evolving. And as it does change and evolve, it creates opportunities. So don't fight the market's personality is my point here. The market has a personality, and that personality gets played out every day, and it either becomes a happy market, it becomes a sad market, it becomes a lethargic market, but the market takes on its own personality. And that really, to me, leads you to the best trades if you understand the personality of the market right now. And then the second part of the scans really becomes what I call conditional scans. In other words, they're Boolean logic. For those of you who ever studied mathematics or any type of computer programming, it's the simple scenario of if this, then that. And if this happens, then this should happen. And so what Boolean logic or conditional scans allow you to look at are different opportunities. So what I did set up before I came in here tonight was to look at, I want to go to the One Egg desktop just so you can want to look at this chart on the top right hand side over here. And this is Telechart, by the way, for those of you who use Telechart, those of you who don't use Telechart. I like it. It gives me a lot of ability to write conditions and do things within it, and on top of the fact that I've used it since 1992, so I've kind of grown with my trading and analysis, so I'm just used to it, and I like the functionality of it. But this is all the U.S. exchange-traded mutual funds. So there are currently 1,363 of them, which is about 1,200 or so too many. I think our list currently is 164 ETFs that we track on any given day, and that's this list right here. And for those of you who have never had access to that list, you can get it by going right under here where it says library. You can go down to Jim Farrish and you can join our club within Telechart, and that list of ETFs is available within that club. If you don't know how to do it, you can send Don at jimsnotes.com an email, and he'll send you an email how to actually access that. But when you go through this, what I look for, first of all, is I want to look at if the S&P 500 is one of the things that I'm looking at, then, and it's up, before today it was up 6% for the year, and so whatever it is up right now for the year, let's just use 6% for argument's sake. If it's up 6% for the year, then I can always come in here and say I want to add a column inside of here, and I want year-to-date performance. So I can go in and add the column for net change for today. As you see, these are all preset. These are inside the software, and you can go in and add what it was, and then you can filter that relative to whether or not it's ahead or behind. So I'm going to go down here because I have, these are my conditions, these are things that I've written within Telechart. So you can look at different things the way you want to look at them. And I thought, see, while I'm teaching, I try to do two things at one time. But let's just do this real quick. If I come back over here and I want to go off of the May 15th, and this is even a better comparison actually. So let's do it the way that I normally do it. Is you go back over here to Tools, and you go to Custom Date Sort, and I'm going to come back to this low on May the 15th, and I'm going to bring this across, and that tells you right there that the S&P 500 is up 3.17% for that scan period, which is 5/15 through tonight's close. And then I can say sort it, and then it's going to ask me where I want to put it, and I'm going to put it to the left of the table, and then pull this back over. And this column right here, when I hover over it, you can see right there, that's the sorting of 5/15 through 6/12. So if I want to compare all the ETFs to the S&P 500, I can see right here that the S&P was up 3.7%, and then I'm going to go down this list. I'm going to grab this bar right here, and I'm just going to go down the list, and I'm going to look for 3.7%, and I'm going to highlight wherever it is, and I'm going to, so where we are is right here. So we're going to come right here. NGE is the last one that's 3.7. And if I right-click on this, I can flag what I want above this point or below this point. So I can flag what I want. So first I'm going to unflag. I'm going to unflag all the items above this just so that they're clear of flags. And then I'm going to right-click it again. And I'm going to flag all the items above this. And then I'm going to click that to flag it. Why did I do that? Because if I scroll up, now all of those that are flagged, I can right-click and I can export the flags to a watch list. So I can make all the flags become a member of another watch list. So all I've got to do is now, so what I'm doing is I create a watch list from my flagged items, and I don't want to go through all this because it takes too long to do it. But the point being is that you can see that they're all flagged. Right click, I'm going to create a watch list of the flagged items. And if we go back to the last one that was on that list, which is right here on NGE, and I highlight that, you can see that that's 428 of 1,563 items in the list. So of that, there are 428 ETFs that outperformed the S&P 500. So when I export those over to another watch list, I can filter them again by filtering out volume. So if I want anything that has traded less than 100,000 shares to be excluded, I exclude those. So that would filter the list down. I'm going to tell you that filters that list down in half. So I'd have about 214 ETFs. And then I would go in and say, all right, I want those that have outperformed the S&P 500 by 25%. And then I would chop off another 30% of those. And you see what I'm getting to is I'm starting to filter the list down conditionally to where the list is going to become manageable to maybe 10, 12, or 15 ETFs that I can now trade based on what I'm doing. So let's do this real quick. I'm just going to try to write this on the screen so you can follow along without, because going through all of that would take me the rest of the webinar to do. So the first thing I'm going to do is I'm going to pick an index that I want to compare this to. So I'm going to compare it to the S&P 500, which is up 3.7% year to date. All right. Then I'm going to take a list which is all ETFs. And the reason I'm using ETFs is that gives me all the sectors. And I'm going to flag them by those that have performed at 3.7% or better. And then I'm going to take my flag list and I'm going to create a new watch list. So you get what first of all, we have to scan it. But the reason for the watch list is now we've got to build what watch list we want to trade from. So as we go through this, we'll actually create, I'm going to call them filters, and filters or conditions is what they are. And so from that watch list, I'm going to start to filter down what I want relative to what we're looking for. So what are we looking for right now? We're going to look for one of two things. So we'll end up with two watch lists. The first one is we're looking for positions that are rolling over and are near support. So in other words, we're looking for ETFs out of that list that have started to roll over. And how we would filter for that is we would take the high from 3 days ago. So in other words, we're looking at the high from 3 days previous is equal to or greater than the S&P 500. So in other words, if the S&P 500 off of its high here has moved down to here 1.6%, which is, I'm just making that number up, but if it's moved 1.6%, my next conditional filter is I only want to stay in the list those ETFs that the high of 3 days ago is less than the 1.6% or greater than the 1.6% decline in the S&P 500. So I'm going to take the high. If it's fallen more than 1.6% or more, it stays in the list. So what are we filtering for? We're filtering for sectors or ETFs that are breaking down. we're looking for the short trades. Remember when we started the webinar, all the stuff that we scanned and talked about is here. We're looking for the short trade. In other words, we're looking for those things that are accelerating to the downside. The second trade that we talked about that was setting up is the one that would test support and then bounce. That trade would have to find support first. So tomorrow, so we can't really build it yet. If tomorrow 1925 is the level that we were looking at on the S&P for support, if that holds tomorrow into the close, then after the close tomorrow, I'm looking for anything that held that support. And let's say that the S&P closes at 1935. That's 10 points on 1900, or about 0.5%. That means that anything that is 0.5% or greater off of its close from when? The close from today. So today would establish the low. Tomorrow would confirm it was the low. So we're going to run the conditional filter for that position. What I'm getting to is that you're going to filter for the things that are in favor with the market. You're not filtering for a needle in a haystack. You're filtering for things that are following the momentum of the market. The number one rule in trading, in anything short term, the number one thing that anybody I know of any credibility scans for is momentum. We look for volume momentum. We look for MACD, stochastic. All of those are momentum indicators. And what people are filtering for is you want to filter for what's in favor with the market. So you're scanning first to see what the market's personality is, and then you bring in all the technical components, and then you scan the market based on those pieces to start filtering your list down and come up with a manageable watch list. To me, that makes so much sense. And yet, I watched a webinar today that someone did on, I don't even know how to explain it in layman's terms. And basically it took one momentum indicator and one directional indicator, which, by the way, the basis of a directional indicator is momentum. But anyway, you take a momentum indicator and a directional indicator and you correlate them together to give you trades. And you run that same scan every day, regardless of the market's personality, looking for this event to take place. And by the time it was done, I looked at it and was totally, politely, I guess I would say I had to say bullshit. And so I went to the website of the company that did the webinar. I pulled up their historical records of their trades. And, I'm not looking for performance. I'm looking for actual trade transactions. And I want to look at trade transactions based on the strategy, and do the trade transactions match up? And that's what I look at when I look at our trade transactions. Are they matching up to what we're trying to do? And if they're not, then I'm off base. I got to get back on cue. And so what I found I looked at 100 trades, and out of the 100 trades, I only found 20 that correlated to what that whole webinar was about, meaning that the bulk of the other trades, I have no idea how they got into the list. And so when you're doing this and you're following things, make sure you understand how they're built, why they're built, and what they do, and what they're leading you to. So that's why I've spent the first half of the webinar tonight plus on just trying to set up two premises for a scan. And that is that one is I want to know that what I'm filtering for based on my conditional requirements are going to lead me to a watch list, first of all, and then second of all, lead me to potential trades out of the watch list. Otherwise, I'm wasting my time. I want to trade within the personality of the market, one, and two, within my own personality. And so those are the two things that really do matter to me as an investor and as a teacher, teaching people how to manage portfolios. It's very important. So hopefully, writing that out helped you see that you're looking at the S&P, you're looking at what it's done year to date. You take all of them, you flag those that have outperformed it, and then you build your flag list, and you start to filter it and based on conditional issues. And we did two. We were looking for those that are rolling over as short trades, and then secondly, which we can't build this one yet, but we may be able to build it tomorrow, Monday, Tuesday, or Wednesday, is support bounce. And a support bounce, there's one of the two trades are going to set up, either the short trade setup or the bounce trade sets up from what we're going through currently. Now, statistical probability, if you study that, the statistical probability is in favor of number two, which is a pullback bounce because of the longer-term trend lines. In other words, if we were looking at a micro trend, so understand, I went through that again for a reason, that when you look at short, intermediate, and long-term trend lines, they are on the upside. That means that micro trends tend to, they have to get down to the trend lines. And I'm going to erase this, so hopefully you got what you needed out of that. And what I mean by what I'm saying right now is that, let's scroll this back. And if this blue line right here is the trend line, in order for a short trade to work longer term, longer than just a trade or a swing trade, then this right here has to, in other words, you've got to get this to flip upside down, and it's got to break that trend line. And from this point right now to that trend line, you can see is 3.5%. The S&P's got to fall another 3.5% before it gets to the trend line. And that's just getting to the trend line. So it's going to deal with support at 1925 first. It's going to deal with support here at around 1895. It's going to deal with support at 1895, 1890, and then it's got support at 1883, and then it's got support again at 1870, and that 1870 support right now would correlate to the trend line. So what you've got is you've got about 5 support lines before you're going to get to the trend line, and the trend line becomes the major support before you can say this market is set up for a short trade. I mean, and looking longer than a week or 10 or 15 days. So make sure you understand the environment before you jump into something that's going to bite you in the butt. I think that today's market set up very well for a support reversal. In other words, it's set up for what you saw right here, is you got a reversal and a bounce. And you actually had one bounce, 2 bounces, 3 bounces. The third bounce was the charm that worked. We may get 1, 2, 3 of these before we get something that works. But let the market set up its personality, and then you take what the market gives you. Because let's just do this real quick, because this is kind of off the beaten path, but this is one of the things that is one of my pet peeves. The market bounces off of this, and we were looking for it to go here, but it didn't go. It traded back. So if you made that trade, odds are it was a zero profit trade. It bounces, you make the trade again, and it reverses. Let's say we maybe lose a little bit of money. And then it bounces again, and it reverses, and maybe we make a little bit of money. But we had 1, 2, 3 trades that, for all practical purposes, were frustrating because they didn't really work the way we wanted them to work. And then the fourth trade worked. And the fourth trade right there off of the S&P actually made 3.5% as it resides right now. So if I broke even, lost 0.5%, made 0.5%, but came out of this even after 3 trades, and then I make the 3.5% here, those trades started right in here, which is around the April 11th time frame. And so from here to here is 2 months. If you can make 3.5% every 2 months, there's 6 of those periods in a year, that comes out to 21% per annum, and that's a pretty damn good rate of return. The problem is we're so focused on we want to double our money that we don't accept what the market gives us by being disciplined. We get off track. and stay on track with the trading. This is when I talk about disciplined trading. That's disciplined trading. If I know that I'm looking for a reversal and I don't get it, try again. I don't get it, try again. When do you stop trying? When it violates the support or the previous low. So if it takes this one out, I may quit. Or if it takes that one out, I definitely quit. But you have to let it violate the strategy. And until it violates it, it says it wants to work. It's trying to work. But we're jumping out of the boat because we're giving up instead of letting it work. And that, to me, is where too many problems are created in the trading process is people quit. And one of the reasons that we've quit managing money a lot for people is because between 1, 2, and 3 is my phone rings or my email dings or my, and I'm getting frustrated by somebody saying, Do it yourself. It's not easy. Anybody who says that trading's easy, anybody who tells you that system development for trading is easy, anybody who tells you that anything about what we're talking about tonight is easy is full of crap. I've been doing this for 32 years, and I'm going to tell you, it ain't easy. It takes a lot of work, it takes a lot of effort, and it takes a lot of discipline, and it takes a lot of effort to become good at trading or managing money. And, that's, I can't say that any plainer, but I do think that that's a very valid issue, that you can't abandon the strategy. You have to stick with the strategy. And if this strategy is that we bounce here and we move and it doesn't work, it's got to violate the low. It's got to violate that 1925 low. And then it invalidates it. We've got to go on to the next story. So let it sequentially build on itself. Time is your friend. You don't have to trade every day. You can sit in cash. You can do a lot of things, but use the opportunities that are presented by the market relative to what it's doing. Now, I want to go back to these filters for a second. All right. Now, let's pull this back over. And there's a couple things that I'm going to throw out here that I don't have time to actually set all these up for you. But one, you can see that on trailing 5, 10, 21, and 63-day periods and year-to-date periods, we actually benchmark the market. So we look at, that's one of the scans that we run, or filters or conditions that we run against the market really pretty much on a daily basis. So we're always looking at who's outperforming or underperforming the benchmark, whether we use the S&P, the NASDAQ, the Dow, the small caps, mid-cap values, or whatever, whether it's the EFI, the emerging markets, currency, whatever the benchmark relative to what we're looking for is how we do a lot of I call them comparison scans. In other words, we're comparing what they've done versus what the index has done. Other things that we look for are reversals. And one of the things that I'm very intrigued with right now, because you should start to see this happen if it's true. This scan is the 1030 crossover scan, and 1030 crossover scan is looking for bottoms. And so that what we're anticipating is if we flipped this upside down, which you can see the S&P 500 right here, but if we flip the S&P upside down, that would be SDS, which you can see is the short S&P. So when we flip it over, it's just the inverse of the chart. So a 1030 bottom reversal, if I'm looking for shorts, then the short ETFs should start showing up if we're going to get a 1030 cross. It's a little bit early for too much of that to transpire, but it will start to transpire as this unfolds, and it's something that we start to look for early, because sometimes you get some early trades that you won't find other ways. So let's go back up in the list so I can see the check marks. And all this is doing is taking that condition and it's looking for it. So I'm going to pull this up so you can see what it does. And if I go down to my conditions one of the conditions you can see right there is the 10-day moving average crossing up through the 30-day simple moving average is all I'm looking for. So if I edit that, that's how you write the conditional scan. So in other words, it's taking the average close 10 days ago, and it wants it to be less than the average close from 30 days ago, and then the average close from 10 days is greater than the average close from 30 days. So all you're doing is you set that up, and you can actually add that column. So once down here it tests the formula. If the test passes, it works. If it doesn't pass, then you're in trouble. You can see it right here on the calculation speed. If that's green, it works. If it's red, you've got a problem with your syntax errors, and you have to rewrite the formula. But bottom line is it works. So I click OK, and it is there. If I want to close that, or if I want to add that, I just click the plus column, come down to My Conditions, and I find it, and all I have to do is click on it, and it adds that column right there. If I want to remove the column, right-click it, delete it, and it goes away. All right, so we have it right here. So let's pull this over. And let's pull the chart over this way. And what we've got is you can see GDXJ is true today. So it crossed over today. But if we were running other scans, which we do run, and which one right now would have been the close of whatever number of days ago that was, that today's close is above that close from 5 days ago. So we do conditional closing points, which will tell you that you're breaking off a consolidation or a pattern point. If it happens in the gold miners, then what else is it happening in? And it will show you other ETFs that are doing the same thing. So you can set up a lot of conditional filters that will give you similar ETFs that are not necessarily in the same sector, but it shows you what's starting to happen within the market relative to turns. And that's what we're looking at right now is a turn. So you got GDX, you got Ireland, which is interesting. Some of these, there's the 20-year Treasury had a cross, TMV, which is the Treasury, and then you got mid-cap Treasury on the 5-year, TBT, which is short the Treasury, PGM, and so you see some of these are going to show up that are worthless. Some of them will be repeats because there's more than one Treasury short, there's more than one Treasury ETF, there's leveraged, unleveraged Treasuries, but you start to see what's happening relative to the shift, and that you're getting gold miners are shifting, and you're starting to get other things that are moving. So let's go back. I want to go back to this for a reason. GDXJ, the 10-day has already crossed up through the 30-day, but if we go to GDX, that's not true in that they're separated. Why? It hasn't accelerated, so the big miners, the large cap miners haven't accelerated as fast as the small cap miners, which means there may be more play within that as it goes along, but it just gives you opportunities to filter and see some of the other opportunities. So all the bottom fishing that we look at is generally a 1030 crossover scan. It's pretty simple. There's no magic to it. Another one that we run when we start getting consolidation is an inside trading day. And if you study anything with technical analysis, you know that an inside trading day, when you get one, that it generally means you're going to get, it's sort of like a doji in a candle pattern on bars. Inside trading days on bars generally are set up for directional changes. And if you get 2 inside trading days, all the better. But you can see on EIRL, here's your bar, here's your second bar. It's well within it by the high and the low. And so just so that you can see, since I brought it up, pull this over. If I go in here, I'll pull this up, we can see, we'll scroll down to Inside Trading Day, which is right here. Click on Edit, and there's the formula for scanning for inside trading days on the bar charts. And again, what I'm looking for is that inside trading day, And what you'll start to see are pennant patterns, flag patterns. So what you've had is a move up, and then you're going to get some type of consolidation. The inside trading day generally is going to be at the apex of the breakout of those patterns. So what you're looking for is a way to filter and then catch the break up or break down out of that pennant. And remember, pennants are bullish patterns. So, and flags, are bullish patterns. So what we're looking for is an upside break. So if this inside trading day and you got kind of a pennant formation in here, let me close this. I'm going to draw here for 1 second. You got kind of an inside trading day on that pennant. So if this follows through and breaks higher, I like the trade. If this breaks down, I'm not really, that's a low probability trade. It generally is going to be a false break. More than 60% of the time it's false. And or you got a directional change within the sector of the market, which in this case, Ireland would be the EFI index, which is the mature markets of the world. And if that would say that the EFI is probably moving down and this is breaking down with it. But if it's following true to its trend, it should be moving back to the upside. So what we look for on inside trading days is just that. I mean, all we're looking for are ways that we can catch these, and then see, you're going to get a lot of these. When you filter all the ETFs, you get some of the junk because you got all the ETFs in here regardless of volume. And you can see that one traded, BICK traded no shares today. I'm not a big fan of trading those kind of things. But so you look for inside trading days that make sense to you relative to what the volume is within each of those. And then you can see here, this is the emerging market small cap, and you can see you have an inside trading day. But you notice that a lot of time that these come up, they're pennant formats. And then the second one that I have built here is the inside trading day for 2 in a row. And you can see that list is much smaller than the list for the inside trading day for 1 day. And then if you click on it, let's find one that actually has some volume. You got the hedge macro tracker, has a little bit of volume, not much. But again, what you've got is basically it's setting up for a pennant trade. And you can see junk, this is the high yield bond fund. So I look for ones that make sense out of the list. Generally, there aren't many of them. But there's a perfect pennant pattern. And then that, because the previous trend is to the upside, that should follow through on the upside. If it breaks down, then you got to go look at why it's breaking down from my perspective. Just because it broke down isn't a clear trade to me. That pennant trade is set up to go higher, not lower. If it's a reverse and upside down pennant and it's a bear pennant, that's a different story. If it's a bear flag, different story. So look for ways that you can, and these are just ways that we find pattern trades, so they're there as well. Now, I really am running out of time, so I'm going to flip to 2 things that I wanted to go through tonight. In conclusion, clear this off. One of those is what's going on with the that's not what I want to do. That was going to happen. Pattern trades. Now, this is not on the website at all. What is on the website is when the trades are published. This is just something for me that I track. I track everything we post. I track just so that I have a record of what I put out there. And what I just went through is a couple of conditional setups for whether they're pattern trades, bottom reversals, they're technical events. And for me, a pattern on a bottom reversal is a pattern trade for me, because generally you've got 2 things. You've got a clear trending downside and a reversal, or you have a trading range bottom, a wedge, a triangle. You have some type of consolidation at the low point, and then it reverses and goes back to the upside. And if we look at, just as an example, KBE, which was the egg from last Friday. We got stopped out of the egg today, by the way. You can see that you had a clear downtrend with a bottom reversal. And that is a pattern to me. In other words, it's trending down, and it consolidated within kind of a V bottom, double bottom. It'll create some type of a bottom pattern that will break back to the upside that creates the trade, which is exactly what you had here. The breakout was 32.25. The entry was 32.50. Our stop was at 33.25 on half, 33.05 on the other half. We hit the stop on one half yesterday, the other half today. But so the trade sets up and you take the trade. I mean, there was no magic to the egg trades. It was purely a pattern trade based off of what we were tracking relative to our egg criteria. It just happened to have a pattern within it. And a lot of trades generally set up with patterns if you look at technical analysis. So a lot of things are very important relative to what's going on. Now, when we look at this, where we see this right now is what the pattern trades are doing is, I want to pull this back up if I can find my line. There we go. Is that when we post them, you can see I posted, these are the ones that were out there coming into today. So they're on my watch list: XOP, STX, JOC, and Yelp. So you had XOP is oil, and you can see that the entry point was 78.40. So let's put it up here on XOP. And you can see that got the wrong thing. Let's try XOP. It went above the 78.40 entry point yesterday. So that was set up. And if you look at the entry on that, it came up yesterday, and we added it yesterday to the list. So we're in it. It's up 1.76% from the entry point. STX, we did not hit the entry point yesterday or today, but you can see there you have another V bottom. We traded this off of this low and off of this low, and then with this getting ready to break higher, if it could take out some of that resistance, I thought that would make another nice trade for STX on the fact that we're taking out this downtrend that's clearly in play, but we've gotten caught up in the market right now. But I still think that that trade sets up very nicely going forward. So the point being is that all of these things get posted that I think are valid trades that I'm willing to put out there, and we trade all of these ourselves. So, I mean, we're putting money into what we trade. We're not just putting trades out here. We're putting money into trades, which is why we track them all, and we track what's going on with them. And then I track what's happened to them historically. You heard me say earlier that one of the things that we're concerned about is, are we sticking to our knitting? In other words, if the pattern trading strategy has to historically match up to what we're looking at. If it doesn't, then I got to get back on task. So the only way to do this is to make sure you're journaling and keeping up with each of these things as you go along, having tools that work for you. So the spreadsheets that I build, these are just Google Docs. You can build them in Excel. You can build them wherever you want. Is we're just tracking realistically what's transpired. And this trading pattern was started on the website on 9/1 of last year, so we've tracked it all the way out. Closed positions, I know we started with 100,000. The closed positions are worth 124,993. If I go back to the positions with unrealized gains, then I know that we're at roughly with unrealized gains at $130,500, or we're up roughly 30%. For whatever period of time that is June. That's 9 months. I'm good with that. Anything over 12% on a 12-month rolling basis, I am happy and tickled pink because I don't want to lose money. But when I say that 12-month rolling basis, I want that to be without losing money. I don't want to have a down 20% year that I got to go out and make that up. I want to make 12% a year, 1% a month, and not lose money going forward. I'm going to have negative trades. You can see the negative trades in the history reports, that we have negative trades where you lose 2.5%, lost 2.7%, 4%, 1%, 1%, 1.6, 2.5, 3.7. But I want the other trades of 17.7 and 5.7, 7.4, 6.1, 3.5, 6.2, 7.2 to make up for those losses. And that's what we're constantly measuring. And we used to measure how many right trades we had versus wrong trades, but I think that's a negative enforcement. What we're looking for is how profitable the trades are on a composite basis. In other words, are we making money? If we're making money, then the strategy works. If we're not making money, the strategy doesn't work. And because what happens is you can tweak your strategy so much that you lose the ability to trade it because it becomes too fine-tuned. I want to stay in a what I call, a freeway lane that I can change lanes and work within the market environment that I'm in to trade my money without getting overly anal about whether or not every trade is winning. I don't need every trade to win. I just need the trades to win to make more than the trades that lose. And if it were 50-50 and my winning trades were up 5% and my losing trades were down 1%, I'm good. That's really the way that I see it, is that you don't overanalyze the strategy, is what I'm saying in a simple format, we get way too analytical with it. So with the pattern trading, this is on the website. This is in there. It's every day. It's on the update. If you go into the research update, which I haven't posted today's research, but I have updated some of the pieces of it. But when I go into the research page, you can see today's notes were, because today's June the 12th. When I click on them, these are up in the morning. If I'm not traveling, these are up generally by 5:30 a.m. East Coast time. So you have plenty of time to deal with them. And you can scroll through the notes and you can come down to the pattern trading setups. It gives you the setups for the day, and then it gives you the trading follow-up. These are still the open positions. We got stopped out of NPSP today. We didn't hit stops on anything else. I update the stops every morning relative to what we think the market environment is. The more choppy it gets, the tighter the stops get. The more trending it is, we'll leave the stops fairly loose. We manage the risk when we need to manage the risk. Otherwise, we give it room to move around. And so the focus is to manage the positions on a day-to-day basis relative to the pattern setup. So the reason I went through that is I wanted you to see all the way through the scans, how we set them up, the watch list, how we set them up, which is, I just went through how we filter for pennants and other things. I didn't get through all the patterns, but that gives you a good example of how we, just for one pattern, that I can do conditional looks. And then I create my watch list from those. And obviously, once I go to the watch list, we have things that we use relative to indicators that tell us whether or not we want to be in them. And believe it or not, our indicators are not indicators that you chart. They're indicators that we have tracked historically for over 25 years that I know work. And they have they have 50% to do with the market's personality, and they have 50% to do with the market sentiment as it exists on a day-to-day basis. And so though a lot of people say, well, what are your trigger points? Our trigger points really is the market. It's not, did the MACD do this? It's not, did stochastics do that? It's not a lot of things that a lot of people are looking at. And the reason for that is by testing this with real money, real time over life, it has borne out that the market's personality is more accurate than a lot of those indicators are on a day-to-day basis. And so it's just a way that we've been able to put it together. Now, so that gives you how to build a watch list, and then it also shows you how to put them into play by the fact that you have right here entry points on all of them. You have stops on all of them. On the patterns, I don't use targets because we let the stops take us out. because it's just the way that we do it. When we put targets in, it brings another variable into the issue. I want to let it run as far as it's going to run, and when the personality of the market changes, we're going to take the money off the table. If the stop doesn't take us out, the personality of the market will. And so that's about as simplistic as it really does get for scan, watch, and play. Now, I've kind of gone through that quickly, and the whole series of this thing, the next couple of weeks, is using tools for the trade in Telechart. So next week I'm going to bring back some of what we've talked about, and I'm going to refine it down a little bit more, and we'll actually look at some of the execution points as to how do you take this to the next stage, which is trading it. And then, because beyond the trading part of it is, once you trade it, is you got to manage it, and that's a whole different venue. So what we'll do is we'll come back next week and we'll recap how we get into the scan, watch, and play, but we're going to focus on the play. And what I mean by that is putting it in play is the first part, and then the second part is managing the actual asset itself by the risk that's defined within it. In other words, the market with banks, I want to go back because this will give you a good example as to what I'm going to get into in the webinar next week, is with KBE. If the personality of the market today wasn't a negative bias that showed financials one of the leaders on the downside, then we would have adjusted our stop to account for the fact that the personality of the market wasn't saying that banks were going to go lower if it continues through tomorrow. In other words, if the personality that developed today carries into tomorrow, then KBE may go back down to 32.50. That erases all of our gains. I'd rather lock in the 2.5 or 6% gain that we had on the trade, take my money, and see how it plays out. Because the egg is designed not to hang around. It's to capture 1 to 3% and get out. And that's exactly what happened with KBE. So understand what you're doing with it. If we go back to the pattern trades and we look at those pattern trades, they're set up very differently from the standpoint that we would like to hold them as long as possible. And we trade off of daily charts on the pattern trades, by the way, so that you know that those are coming from daily charts. They're not short-term trades from the standpoint that we're looking for something to go away tomorrow. And, example would be Bank of America, which we own right now on the pattern trade. Now, because it's not an intraday service, if it was, I would have actually sold Bank of America at the open today. In other words, if I got into this trade and I'm out of and I get the catalyst to the upside, the personality of the market, the sector, and the stock changed today. So I went to the market first, went to the sector second, and then I go to the stock third, and the personality changed. And because the entry point on this was 1535, we're at 1542. The stop as we came into today's trading day was 1535. I would have sold on the open this morning at around 1555, and I would have been out of the trade. And I think that is important, that you understand how to manage the trade. That's what I'm going to get into next week, is how do you manage the trade once you get in it. So we'll set it up. The first part of the webinar will go into how we set the trades up, and then we'll go into how we manage the trade using the tools that we have in front of us. So sorry for going over. Really, sometimes getting through these things takes a little bit longer than I always dream in my mind that they're going to take. But look for what is there and look at for what the market is. And, one of the questions that is on here is, what I mean by personality of the market. You're right in what you're saying there, in that it is the trend. It is whether or not it's reversing. It is whether we've got accelerating volume on a negative day relative to previous days. What's the average volume relative to what we're looking at? Are we getting any true rollover in the market? Just because the S&P rolls over doesn't mean the personality of the market's changing. It means the personality of the S&P is changing. But if the composite index, the NASDAQ, is joining it, then it's probably true. And if the Dow Jones Industrial Average is joining along with it, then it's probably true. And if small caps are going to the downside, then we've got to be concerned as well, because the small caps are just as important. It's very important that you understand what the market is. The chart is just one part of the personality. The biggest part of this is that you have to find the other pieces. And the other pieces are the news and the fundamentals, and are they changing? Sales data today was a very important, I didn't even get into that, but that was a very important indicator today. I mean, we can all massage that number by saying the April number was revised up. It made up the difference of the shortfall for the May sales. All we said was April was better than May. That's not an improving indicator. That's a negative to me, which doesn't bode well for the June numbers. And so sales data I didn't like that number at all today. It actually was very disturbing. So that personality changed the trend that we had of positive data reports. Inventory had built up. We got the inventory data report yesterday, which confirmed retail sales being weak in May. Inventory is building up in May. So you're starting to build a personality shift in the market that's fundamental, technical, and news-driven, which is changing sentiment. So this may not pan out. It may pan out, but you have to be aware of the personality that's taking place in the market environment, or the market's going to smack you in the head. Good traders understand and can relate to the market's personality, and they trade in sync with the market's personality versus trying to tell the market what they think. The minute you find yourself telling the market what it should be doing, you're off basis. There are things that happen in the market that I don't understand day to day, and they eventually pan themselves out and filter themselves out to why they did it. But I have to be patient and let them build. So I'm going to close with this. Remember that the 7 roadblocks. Know what you want. Understand the psychology of money. Risk management. Be obedient to the natural laws of money. Continue to educate yourself about money, not just about technical analysis, but about money. What drives it, what makes it work, what makes it not work. How to manage your money, which we'll talk about a lot next week, versus the markets, and have a written plan. Know what you're going to do before you do it. And you see that I write notes everywhere. I have all kinds of things. I mean, these are notes that, this is the scans for tomorrow, which was just posted before we started the webinar tonight. But those egg scans are telling you more. The reason I have the egg scan, and the reason we trade the egg scan so much, is it directly 100% relates to the market's personality. And people say, well, how do you get to the egg? It's so different than anything you probably would imagine that you would laugh at me. But you have to understand market personalities and what drives market indicators in order to get to the egg. It's not anything of, we say if the MACD does this and the stochastic does that, then that's the egg. It's the personality that's driving the egg. If we weren't already invested in KBE, we would have bought GDX yesterday. And because of the way that GDX had set up relative to the gold miners. And you can see what happened to GDX today. And that was on the report yesterday, so I'm not making this up. You can go back and look at yesterday's notes. I put in the last night's trading scan notes that the miners were moving. GDX and GDXJ both made positive moves on the upside. So use the data that we provide to you. It's there. It's beautiful. It is what it is. I'm not perfect by any stretch of the imagination, but I will tell you this. I'm more deep than I am wide. I would rather drill deep into the market and find what's moving the market to find one thing than to go wide and own 20. So use that for what it means. With that, I'm going to shut up and let you guys go eat dinner, have lunch, do whatever you're doing, wherever time zone you're in. But we'll see you next Thursday. And if you have any questions, feel free to shoot me emails, jim@jimnotes.com. Have a great evening.